I suppose part of the difficulty for investors is the first thing is, and I want to throw up this Bloomberg chart that we've been looking at a lot over the past few weeks, which is just how enticing it must be to buy into these rallies, right? Because we do know, and this goes back to 2008, it's that bear markets do produce some really enticing rallies. Are you fully invested at this point? I mean, how much cash would you be holding on the sidelines, and how much harder is this crisis to navigate versus a true credit crisis?
Well, from a personal investment advice perspective, I would not try to trade such a market. If you have cash in your savings account for upcoming bills and purchases, it doesn't belong anywhere near risky markets at this point in time. On the other hand, if you're a nearing retirement investor and you're starting to feel like you have more risk in your portfolio than you're comfortable, I would say, come up with a lower risk policy portfolio and average into that over coming months and quarters. And if you're a young investor, you should just think of this as a wonderful gift and an opportunity to be regularly contributing to your retirement account at bargain basement prices. However, in my position, I'm a professional asset manager who's responsible for tactically allocated and timing these markets. So we're nowhere near full risk on. We intend to get about half risk on over coming weeks, because we can now start to see the contours of what looks to be peak fear. Peak fear is when you want to buy. When is peak fear? Well, peak fear in a pandemic is probably somewhere between the peak of new cases of the virus and the peak of new deaths. We could be pretty darn close to the peak of new cases right about now, although the peak of deaths is likely to be mid-April or maybe not even until the end of April. So April seems like a really good time to take a first big step into re-risking portfolios or increasing your positions. Though I would hold back from going all the way because things could get a lot worse.
Right. So mid-April is basically when you're saying that the market will truly panic and start pricing in the end of the world.
Well, yes, I think James McIntosh in the Wall Street Journal had it right today when he said we're all amateur epidemiologists today. Two of my partners, the founder of my firm, Rob Barnott, and another one of our partners is a professor at Duke University, Cam Harvey. They're both running their own models of the spread of the global pandemic. And we really had to do that because until early this week, there were no published models out there. We were going blind, so we were all fitting our own models. And yes, we've kind of the models we've been looking at, both our own as well as, for instance, the models that were discussed in the White House briefing yesterday, are pointing to mid-April as the peak. So that seems like a pretty good time to be averaging into positions. Would you like me to share, where we see some of the great opportunities?
Yes, please.
Well, let me highlight three areas. One in interest rates, one in FX, and one in equity markets. In interest rates, here in the U.S., the break-even inflation rate, the difference between 10-year nominal yields and 10-year linker, or we call them in the States TIPS yields, is down to about 1%. And does anybody really believe that inflation is going to be only 1% for 10 years? For 10 years, that certainly can't make any sense, especially with many trillions of dollars of additional deficits here in the U.S. funded by money printing by the Fed. I think I'd take the over on that for sure. A related issue from interest rates is FX. The dollar started this year being very expensive relative to most of the rest of the currencies in the world, and it's gotten a lot more expensive during this coronavirus period. All the while, we've got sort of extreme money printing. Now, I get that there's a shortage of dollars, and the Fed's trying to remedy that as quickly as it can with all sorts of facilities, including swap lines to both developed and emerging markets. But I think taking a multi-year horizon, we're looking at a real all-time peak in the dollar. And the sort of decline in the dollar, or from a U.S. dollar perspective investor, the appreciation of foreign currencies that we saw in the order of 30 to 40% in the period from 2000 to 2007, I think is likely to be repeated. And then lastly, there's just a huge opportunity in value stocks. We had about a dozen-year period of underperformance for value to the tune of about 4% per annum underperformance of value, and now things have gotten even cheaper. To give you an idea of what I'm talking about, we've got a situation where value stocks around the world are trading in low single-digit PE multiples,
right.
only 20% the valuation of markets, and so again, probably the easiest and the most direct way to participate in this coming rebound is acquiring a nice diversified portfolio of value stocks.